A short time ago, the United States military began major combat operations in Iran.
Why is silver dumping right now? We are in the middle of a full-blown US-Iran war, and silver is the obvious safe haven trade, but it's down. The answer is simple. It's manipulation. Well, the narrative right now is war equals safe haven trade, so you must buy silver, right? That's what everyone's been saying over the weekend anyway. Silver will go up for sure, blah, 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 but it's not working out. And here's exactly why. Look, silver is doing so well right now that it's caught a lot of attention from retail traders. There's a lot of new people getting into silver. And as always, retail brings the vultures with it. Market manipulators like banks are the vultures, right? And how do these manipulators work? They know retail traders follow simple patterns. War equals safe haven trade on gold and silver. So what do? They push out this narrative throughout the media. They reinforce this narrative to retail traders. And this is a perfectly logical narrative too, because it usually does play out this way. So retail believes it. But the catch is they've already bought before the war started because they knew that the war was coming. We clearly saw proof on Friday when silver pumped 6%. On Friday alone, it pumped 6%. That was the manipulators getting into the market. Then as soon as the market opens, they know retail are going to pile in and say, oh my God, safe haven trade activated, we must get in. Then boom, they dump on retail.
When the markets opened last night, we saw both gold and silver gap up, and for a moment, they were soaring. In fact, silver went as high as $97 an ounce, gold up to $5,400, but it was short-lived. Silver Trade wrote on X, massive volatility in silver trading, never seen a chart like this. Silver gaps up to 97, gaps down to 93, gaps back up to 95. So yeah, I would say this is extreme volatility, and I would expect more of this to come. Just as the markets were opening in the US, silver was slammed down to below $90 an ounce. And as I pointed out at the start of the video, both gold and silver were getting slammed down. So what is the reason behind this? Well, the first thing I want to point out is that the US dollar index is up for the day, so the dollar is getting stronger, and whenever the dollar is going up, generally I would expect metals to be going down. However, on the other side of things, when we look at the fear and greed index, you can see it is in the fear category, and rightly so. There is a war going on in the Middle East, and it looks like the war is not going to be wrapping up anytime soon, so we will see how things progress from here. Let's talk about what the metals are doing in China. As you know, they've been leading the way for price discovery, especially when it comes to silver, but look at this post. Physical gold trading at $63.29 an ounce in China. Physical gold stores across China have stopped selling investment gold bars and are only selling craft gold bars at about $63.29 an ounce. I'm not sure what the difference is between investment gold bars and craft gold bars, but either way, that is a massive premium over where gold is. It's like a $900 premium. But not just physical gold price is exploding higher in China. All gold mining stocks hit the daily limit up yesterday, and I guess major banks are experiencing a buying rush with the accumulated gold. This is just the beginning because China has 336 trillion yuan in savings, and March 2nd is going to be really interesting. So we'll keep an eye on what's going on with gold and silver price in China tonight, but it looks like both gold and silver are trying to go much, much higher, and this is going to widen the gap between the East and the West, and ultimately a lot of metal is going to flow into China. Silver closed at a very high level, $110 an ounce in Shanghai. These are US dollars we're talking about, so a massive premium between the East and the West for both gold and silver. And if you live in America, perhaps this is the time to buy the dip, because I don't know how long it's going to last. Apparently, even JP Morgan is making the case for $8,000 gold, but why are they saying that gold could go that high? This surprised me. JP Morgan, gold to hit 8,000. According to their estimates, private investors hold a 3% gold allocation. If this were to rise to 4.6%, gold would hit 8K. Now compare that to what others are suggesting. Morgan Stanley considers a 20% gold allocation. Ray Dalio recommends a 5 to 15% gold allocation, and Bank of America sees 30% as reasonable. If allocations move even partially toward those levels. Just imagine what will happen to the price of gold. I mean, 8,000 could be blown out of the water. We could be looking at 10, 15, maybe even 20K in the coming years. And Bank of America has revamped their silver price target for 2026. Michael Widmer, the bank's head of metals research, projects silver could reach anywhere between $135 and $309 per ounce before the end of the year. Can you imagine if silver goes that high? I mean, with everything going on, I definitely think it's possible. One other thing I did want to point out in this video, as Nostra House of Gold writes, I have bad news for the military industrial complex. You need a lot of silver to replenish all the missiles. Well, there's a worldwide multi-decade silver shortage. So with war going on, silver definitely is needed. And a lot of other industries still need silver right now. We are right in the middle of a 6-year supply deficit. So with the war going on, it has the potential to continue to drain silver supplies. As I'm filming, I'm watching the sell-off continue in precious metals. Silver now down to $87.79. It's down $6.50 or almost 7%. Gold is pretty much flat right now, so the gold-silver ratio is moving much higher, and we do have a gold-silver ratio alert. At the moment, it is above 60, so this once again changes my strategy to include buying silver. I think now could be a good time to buy silver because of the dip. Of course, we could see silver continue to go down from here, especially if we see a big crash in the stock market. We could see silver drop significantly out the gate, but usually it does recover pretty quickly.
The silver market movement we have witnessed today, on March 2nd, 2026, is not merely a random fluctuation. It is a profound signal of the growing tension between the physical reality of industrial demand and the artificial constraints of the paper futures market. When we look at the data provided in the two segments we just analyzed, several critical themes emerge that every silver stacker and institutional investor must reconcile. First, we must address the geopolitical premium that was baked into silver prices over the last 72 hours. With the escalation of tensions in the Middle East and the shifting dynamics of the BRICS Plus alliance, silver was being used as a primary hedge. However, as we saw in the first clip, when the immediate war panic doesn't lead to an instantaneous global catastrophe, the high-frequency trading algorithms, HFTs, on Wall Street are programmed to trigger massive sell orders to shake out the retail long positions. This is exactly what we are seeing today, a clinical, algorithmic purge of leveraged positions. From a technical standpoint, the breach of the $28.50 support level earlier this morning was the tripwire that many of us in the community were watching. In my personal opinion, this wasn't a failure of silver as an asset, but rather a calculated liquidity grab. If you look at the volume profile during the 8:30 a.m. Eastern Standard Time dump, it was disproportionately large compared to the actual news cycle. This suggests that large bullion banks may be attempting to cap the price to manage their own short-side liabilities as we head into the next delivery month. We are currently seeing a massive divergence where the spot price is falling, yet premiums at major online dealers are actually rising. This is the silver paradox. The cheaper the paper says it is, the harder it becomes to actually put the physical metal in your hand at that price. My personal verdict on today's silver crash is that it represents one of the most significant bear traps of the 2026 fiscal year. While the talking heads on mainstream financial media will tell you that silver is dead because of a strengthening US dollar or a shift in Federal Reserve sentiment, they are ignoring the structural deficit. The Silver Institute and several independent analysts have already confirmed that 2025 ended with a massive supply shortfall, and 2026 is projected to be even worse due to the surging demand in the photovoltaic, solar, and EV sectors. When the paper market drops by 5% in a single session, while the industrial demand is growing by 15% annually, you are looking at a coiled spring. Furthermore, we must consider the psychological aspect of this crash. For years, the money stalker community has tracked how price suppression usually precedes a massive breakout. We saw this in the early 2000s and again during the 2020 liquidity crisis. Each time the experts called for $15 silver, the market eventually snapped back to record highs because you cannot manufacture physical silver out of thin air to settle paper contracts indefinitely. In my view, if silver manages to close the weekly candle above the $27 mark, today's crash will be remembered as nothing more than a discount for those with the courage to buy when others are fearful. However, a word of caution is necessary. We must remain objective. If the COMEX manages to push the price below the $26.20 level and hold it there for more than 3 trading sessions, we could be looking at a longer consolidation period that might last through the summer. This would likely be driven by a broader deflationary scare, where all assets, including gold and silver, are sold off to cover margin calls in the collapsing tech sector. But even in that worst-case scenario, the intrinsic value of silver as a monetary metal remains untouched. In conclusion, do not let the red candles on your screen dictate your long-term strategy. The crash of March 2nd is a test of conviction. Wall Street wants your physical silver. They want you to sell your eagles, your maples, and your 100-ounce bars so they can replenish their depleted vaults at a discount. My personal stance? I am not selling a single gram. In fact, I am looking at this volatility as a gift, a chance to lower my dollar cost average before the inevitable physical squeeze of late 2026 truly begins. We are watching the death throes of an old financial system, and silver is the ultimate insurance policy. What is your move today? Are you seeing this as a silver crash that signals the end of the bull run, or are you seeing the Wall Street engineering for what it really is? The data is in front of you, and the experts have spoken. Now, the decision rests with you. Make sure to subscribe to Money Stalker for daily updates as we track this volatility second by second. The game is changing, and only the informed will survive the transition.